Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.
Now is the time to be anxious, but not necessarily fearful, says our next guest, Jeff Christian, managing partner of the CPM Group, and we'll be discussing what this means for investors. Welcome back to the show, Jeff. It's good to see you in person at the PDAC in Toronto.
It's good to see you in person and everybody else, and yeah, it's great.
Finally, after 2 years of lockdowns, we're here back at the conference. Now, Jeff, my friends and I have been discussing the markets, and one of the common themes I've gotten is fear, and we've obviously observed that in the broad equity sell-off that we've seen since November, cryptos as well. Risk assets have all been selling off. People have been telling me, David, I don't enjoy watching your show anymore. Not that I don't like the guests on your program, but it's just I get anxiety every time someone tells me there's a recession coming on, or that's about to come online. There's possibly a depression or greater depression, if you want to call it. The collapse of the dollar is imminent. Inflation is here to stay, and the stock markets are going to be covered for decades. These things give me anxiety, they tell me. And I'm not here to steer you in the direction of good news. I'm just setting the stage for your views on how the economy is going to unfold over the next 2 or 3 years or so. Let's start with that.
Well, yeah, someone I really respect said recently, if you're not anxious, you're not paying attention to what's going on.
Okay.
Yeah, and everybody has every reason to have anxiety over the state of the world, economically, politically, and financially. But you shouldn't be fearful of it. And, fear is when you let your anxieties run wild. And there are fear mongers who are out there trying to hawk their wares based on fear.
Right.
And, so you have Jamie Dimon 2 weeks ago saying, look, there's a hurricane, an economic hurricane coming. And I'm not sure if it's a run-of-the-mill hurricane or if it's a superstorm Sandy, but it's coming and people should be preparing for it, right? And the next day, the gold bugs are out there, the gold touts are out there saying, Jamie Dimon says the world's going to collapse. Well, a hurricane, even a superstorm Sandy, isn't a collapse of the world, right? I mean, I have a lot of friends in Florida, and they've lived through dozens of hurricanes. And when we were younger, we used to have shrimp bakes on the beach waiting for the hurricane to arrive. So, you have to put it in perspective. There are a lot of problems. There are a lot of long-term problems.
Right.
There are some short-term problems. We are heading toward a recession at some point, probably within the next 4 years.
Okay.
Maybe next year, maybe yet this year, but we're not there yet. But, you shouldn't fear it. You should have a lot of anxieties. You should take a deep breath, close your eyes, center yourself, and look at what's really going on and prepare for the worst.
Okay. We're gonna unpack that recession outlook in just a minute. But okay, stepping back here, we should be anxious of what exactly, Jeff? What are the major market risks that potentially would keep you up at night?
Well, right now, a lot of people have already lost a lot of money in the stock market.
Yeah.
And the things that keep me up at night are more the longer term issues and the longer term structural problems that we have in the currency markets, financial markets, global economy, and global and domestic political environments. And it's those longer term things that really worry me. Now, some of those longer term issues seem to be coming home to fruition. So I'm a little bit worried. I'm not necessarily worried about a collapse of the world. I think we will see a recession. I'm not sure how deep or how long it will be.
Right.
It's not going to be a 1929 or a 1947 event. It may be less painful and less severe than the one in 2007 to 2009.
Yeah.
It probably will be worse than the ones we saw in 1991 and 2001. But there is a recession coming. And the stock market has been grossly overvalued, and now it's coming down.
Okay.
It's coming down because interest rates are rising. And you're seeing with the rise in interest rates, bond prices are falling.
Right.
So you're seeing investors pivot out of stocks, which have been overvalued, especially like the tech stocks and the more speculative ones. They're pivoting out of that, and they're putting money into the bond market because interest rates are rising. And they're also putting money into residential real estate. And they're basically financializing homes and pushing the United States away from a nation of homeowners to a nation of renters. And that's a real problem. But that's a longer term problem. But the short term, the government is doing nothing to resolve it or address it.
Let's talk about the recession now, since you brought it up. Okay, so You mentioned that a recession could be coming in the next year or so. The obvious question is, how do you know that? What indicators are you looking at that point to a recession right now?
Well, we've been saying for some time that we thought there would be a recession sometime in the 2024-2026 range. And we still think that 2024-2026 is probably the most probable time when we'll see a recession. So we're not necessarily thinking that we'll see a recession this year or even in 2023. And the reason we say that is because while some segments of the economy are tight, there's a lot of slack in other segments of the economy. And for us to move into a recession, you really need to see a much tighter supply-demand constraint across broader sections of the economy. Housing is clearly having a lot of tight pressures, but that's because of the financialization I just spoke about from housing, where all of a sudden people who want to buy a home to live in are competing with investors who are throwing money irrationally into the housing market. But if you look at a lot of other places, retail capacity, manufacturing capacity, and a number of other segments of the economy, you still have a tremendous amount of slack. And until we see that slack tighten, we're thinking that you can avoid a recession. Also, I mean, part of the issue of a recession is rising interest rates. But, you know, we have interest rates very low. They've gone from 1% to 3.6% for 10-year bonds. 3.6% is lower than probably any time prior to, say, 2016 or so. So we have the capacity to raise interest rates quite a bit to try to quell inflation before we start really damaging the real economy. And if you look at it, interest rates on an inflation-adjusted basis, they're still negative.
Yes.
You know, when we saw the Fed raise interest rates and drive us into a recession in the past, we had 12 years of inflation between 5 and 14%, and the Fed went with interest rates from 2% to 21%. That's not where we are today.
Right. I'm just wondering how much of this coming recession is driven primarily by the central bank of the U.S., the Federal Reserve, because I'm reading various pundits give their opinions on what's going to cause this coming recession. They agree with you, and they're citing their own reasons. So one of the reasons I'm hearing is that the recession will be caused by the Federal Reserve that's trying to engineer a soft landing because they now have no choice but to create an economic contraction to lower aggregate demand, which would in itself lower inflation. Rising interest rates, pundits argue, are not enough to cause a slowdown in inflation. The Fed really needs to engineer a soft landing, engineer a recession.
That's like gibberish. I'm sorry. Yeah, that's
okay.
It's really
Please,
like gibberish. First off, understand the Fed can quell demand by raising interest rates and stop buying bonds, which are the two things it's doing. But if you look at where the inflation's coming from right now, part of it's demand driven, and the Fed can address that by raising interest rates and curtailing its bond purchase programs. But a lot of the inflationary pressures now and over the last 14 months, since inflation went over 1.8%. Because if you go back 15 months ago to February of 2021, CPI in the United States was 1.8%. Yeah, so this is a 15-month phenomenon that we're into, in high inflation, right? Not 12 years the way we had from 1968 to 1980. So the Fed can deal with that, but much of the inflationary pressures we've seen really over the last 12 years and over the last 15 months have been supply driven. Right. And the Fed's raising interest rates doesn't help the inflation on the supply side. In fact, it can contribute to higher inflation. Correct. And then the third component, which the Fed has no control over too, is fiscal policy. And that has been much more inflation fueling than anything that the Fed has done. So the Fed can raise interest rates and on so on. Now, the good thing is that the Fed is not the pundits that you're talking to. The Fed knows that it has limits to what it can do in terms of fighting inflation by raising interest rates. So it's not going to try to fight things that it can't control with interest rates. It knows better than to shoot bullets.
Well, don't you agree that the Federal Reserve can more or less directly control aggregate demand by simply raising or lowering the interest rates?
Yes, but aggregate demand is only one component of the inflationary pressures. The other components are the supply side of the real economy and fiscal policy.
Okay.
And the Fed has limited control over supply.
Right.
And in fact, raising interest rates is negative for the inflationary pressures on the supply side. And it has absolutely no control over the wild fiscal imbalances that the government, the administration, and the Congress do.
The monetarists would argue that inflation is everywhere and always a monetary phenomenon, which is a quote by Milton Friedman. And they would argue, this school of thought would argue that inflation is driven primarily by the expansion of the money supply and the expansion of the central bank balance sheet. Supply chain issues had a limiting contributing factor to the inflation that we're seeing today. And so by curtailing the growth of the money supply, the Federal Reserve can directly control inflation. How do you respond to that?
I respond in two ways. First off, one of the worst diseases in the world is economic theory.
Okay.
And if you really want to do economics well, don't have a theory. And the second thing is monetarism was pretty much discredited by the 1980s. The Fed obviously has a lot to do with inflation and growth. Interest rates have a lot to do with inflation and growth, but they're not the end all and be all. And we have proven that over and over again in the 80s and since the 80s. And speaking of the 80s and the Fed, go back to 1987 when the stock market fell very sharply and there were a lot of people panicking saying the Fed should be lowering interest rates. And in fact, it didn't lower interest rates because the Fed accurately analyzed what was going on in the stock market in 1987 and said, this is not an economic factor driving the stock prices down. This is a stock market factor. And CPM Group's view, which actually happened to have been in line with the Fed at the time, was that we wouldn't see a recession until 1991. And we didn't. We didn't have a recession for 4 years. The stock market fell. It had nothing to do with the real economy. The Fed didn't lower interest rates the way all of the people on Wall Street were begging them to. And they were right.
Okay. So let's finish the inflation topic and then we'll move on to something else. What needs to be done now to bring down inflation? I'm not saying done by you and me. I'm saying by higher authorities here.
Fiscal policy.
Okay.
Fiscal policy. The administration and the Congress, they need to get fiscal policy in-house. And the Fed, in its twice-a-year Humphrey Hawkins testimony, since Paul Volcker in the 1980s, goes to Capitol Hill and says, the Fed can only do so much with monetary policy, and mostly it's stanching the bleeding during a recession. And you need to get your fiscal house in order. And since the 1980s, the fiscal house has gone not from being sloppy, but being a hoarder's house.
Yes.
It's a disaster. It's the fiscal policy that matters. And you've got to get the Congress and the administration, which both seem to be full of totally incompetent. They're not incompetent. They know exactly what they're doing. They're working for their masters.
Biden has made inflation a national priority. I think last month or a few weeks ago, I can't remember the exact date that he officially announced that. I don't know what measures is he taking.
None. I mean, that's a rhetorical. He's made inflation a rhetorical national policy. He hasn't done anything to really quell inflation.
Well, midterms are coming up. I mean, he has to start doing something soon. We'll see. All right, we'll see. Let's move on. I want to address a few other collapses and have you comment on them. I know they're going to be fun for you to talk about. The collapse of the stock market. So the S&P 500 is down already nearly 20% from its highs. The NASDAQ a bit more. Certain stocks in the tech sector have gone down 90%. The list goes on. People aren't talking about a correction now. That's already happened. People are talking about a sustained bear market well into the coming decade. And I've heard this from several people that I've talked to on the show now, that we might see a repeat of Japan in the 90s, where the Nikkei didn't go back up until 2 decades later, or a repeat of the post-1929 crash, where the stock market, the S&P 500, didn't recover to its pre-depression highs until the 50s.
Right.
Are we going to see that, Jeff?
I think a better model is 2000, 2001.
Okay.
Going into 2000, you had the tech stock boom, you had productivity booming, you had the dollar very strong, everything was going well. The stock market's going to be $40,000. We'll never have inflation. We'll never have recessions again. And then the tech stock bubble burst. And very importantly, one of the things that happened in 2000, 2001 is they realized a lot of the demand that is making the economy look good was actually winding up in inventories. And right now, inventories are very low, right? And it was those inventories that led to the recession. And you saw the New York Stock Exchange fall 43%. You saw the NASDAQ fall 86% because there were no market makers on the NASDAQ. But back then, the New York Stock Exchange had market makers that would serve as a circuit breaker. They were buyers of last resort when everybody else was selling. And you saw this kind of thing. So I think that 2000, 2001, and again, tech stocks were wildly overvalued back then. There were a lot of speculative assets, and those things, which were on the NASDAQ, were the things that got the hardest hit. I think that's a better, if you're going to look for historical analogies, I think that's much better than 29.
Well, we know what happened post tech bubble bust. The stock market saw a V-shaped recovery. That's what you're expecting?
Very quickly.
Okay.
Yeah.
All right. Well, let's move on to the dollar now. The dollar's imminent collapse is upon us, Jeff. Jeff Christian of the CPM Group, you've got to be aware all your savings are going to be wiped out because the dollar is going to lose the status of the reserve currency of the world. And not just that, in the short term, because of all this inflation that we're seeing, because of this money printing, expansion of the money supply, the dollar will be eroded away. And we're not just talking about 8.6% inflation here. We're talking about the dollar vis-a-vis other currencies that will lose value as well. So lots to unpack there. Let's start with the short term and long term.
Yeah.
Where is the dollar headed in the next 2 years?
I've heard about the dollar's imminent collapse for what, 40, 50 years now, right? And it hasn't collapsed yet. And in fact, it's gotten very strong. You have 62% of foreign exchange reserves held by central banks in the US dollar for good reasons.
Right.
And you also have about 70 to 80% of private financial wealth in US dollars. So the US basically owes the world so much that it owns it. And as a result, the dollar will probably stay much stronger.
Okay. But Jeff, the last 40 years, we've seen hegemony, the American dominance of the world. We've got one superpower, arguably two if you want to count the Soviet Union, but really just one. But now people are talking about a bifurcation of the world order. We've got the U.S. versus another bloc, which is the Chinese and the Russians. And now we've got the Saudis talking about potentially moving away from the dollar for their petrol, moving away from the petrodollar, using another currency perhaps. And we've got the Chinese and the Russians talking about making deals in another currency besides the U.S. dollar. The Russians are asking for the oil to be, exchanged in rubles. I'm just making these cases to illustrate the example that the world could be headed towards, or a scenario rather, that the world's heading towards a system where the U.S. dollar is no longer the dominant reserve currency of trade. Yeah. Is that possible?
Most central banks would like to see an international currency regime where the flow of other currencies are sufficient that you can have a multipolar international currency regime. Okay. Most governments would like to see a multipolar political and economic regimes in the world too. The United States is probably the outlier in all of this. Sure. And the dollar ultimately will lose some of its stature.
Yes.
But it probably will always be, for the next generation or two, the dominant currency. Right. Simply because the United States economy has greater productivity, greater natural resources, greater educational base, and a variety of other factors that will probably keep it attractive to foreign investors. Okay. People worry about the trade deficit, but the reality is that the trade deficit the mirror image of the trade deficit is enormous inflows of investment funds into the United States, because people around the world look at the U.S., they look and say, where am I going to invest? And they choose the U.S.
What about this theory? If the Federal Reserve raises interest rates beyond a point that's affordable for the Treasury, they may have to default on some debt. Is that possible?
It's possible. It's probably highly unlikely.
Okay, highly unlikely.
The Fed is the largest owner of Treasury debts, probably doesn't really want to see that debt defaulted on.
Yeah, we would have to rewrite every single finance textbook ever written about AAA treasuries. The DXY has been strong over the last 2 years, despite record inflation, over the highest level of inflation in the last 40 years. Why is that? Why the strength in the dollar vis-a-vis the strength in the CPI?
Several reasons. First off, as I said earlier, the inflation only started rising in March and April of 2021. Okay. So prior to that, you actually had very low inflation, below 2%. The Fed was saying inflation is below our long-term target, and they were struggling for years to raise the inflationary pressures. I didn't think that was a good policy, but that was their policy. So inflation wasn't a factor there. But what you see is, again, foreign investors wanting to invest in the United States relative to other places. The United States showing a much better prospective place to invest. You had U.S. manufacturers coming back. So you had a tremendous demand for dollars for investments in the United States. And that was one of the factors. Now, since March of this year, you also have the Russian war in the Ukraine. And that actually has strengthened the dollar for a variety of reasons. And so that has added to the upward pressure on the dollar.
Okay, let's move on to gold and commodities now. Not a myth, but this is a projection that gold's going to go a lot higher. I'll get your own projection in just a minute, so stay tuned. At the end of the interview, we'll get Jeff's projections for gold over the next year. But I'm getting $5,000 over the next 2 to 3 years, $10,000 within the next 5 years. These are some forecasts that I've gotten. Generally speaking now, people are talking about a commodity super cycle that gold and other precious metals are in. What is a commodity super cycle? How would you define
Commodity super cycle is a marketing trope. I mean, it's just nonsense. And I wrote a book, Commodities Rising, in 2005. Okay. And there's a chapter where I talk about the commodity super cycle. The rise in commodity prices from 2000 to 2005, actually to 2011, that was economics 101. There was no super cycle. That was economics 101. Years of underinvestment on the supply side, years of low interest rates fueling demand for commodities, finally giving you a supply-demand balance that caused commodity prices to run. That was inflation. That was economics 101. The commodity super cycle came from investment banks looking to market commodities to investors.
You don't believe in the Elliott wave theory where prices move?
No, I don't.
Okay.
And I don't believe in the Kondrafia theory. I have had, in my entire 50-year career, people telling me that the Kondrafia theory says that commodity prices are going to skyrocket imminently.
Right.
That's a 60-year cycle. Okay. And for 50 years, people have been telling me it says that the commodity prices are going to rise. Explain
why the economic conditions now are different than back in the early 2000s. You just said that gold's rise from a couple $100 to $2,000 in 2011, well, close to $2,000 in 2011. That's an increase of 8-fold, 10-fold, depending on your start date, over a 10, 11-year period. Why are we seeing that kind of growth today?
I think you will see it. And what we've been saying for several years, since about 2009, is that what we think we saw from 2000 to 2011 was the first leg of a long-term secular upward shift in gold prices.
It's not a cycle, though. It's not a cycle.
A secular.
Right.
Not a cyclical, but a cycle. Okay. Not a cycle, but a secular shift. Okay. We started talking in 2000, we coined the term a golden renaissance, where investors initially and then central banks later would start rebuilding their exposure to gold as a financial asset and then central banks as a monetary asset. And they would be buying more gold at higher prices for a longer time than ever before. And we said at that time, the gold price was about $260 an ounce. We said, we think that the economic and political and financial environment, not over the next 2 years, but over the next several decades, will be more hostile than it was in 1979, 1980, when the price went from $200 to $850 and then fell $140 the next day. And we said, we're going to see a very hostile economic, political environment for the next several decades. And in that kind of environment, investors initially, central banks later, will start buying more gold, and they'll drive the price far past $850. And we've been right? 2008, 2009, the price of gold crosses 1,000. And we said, we think we're getting to a cyclical peak in a secular bull market. We think the gold price could peak around 2010, 2012, and come down for 3 to 5 years before starting to rise again. Okay. It peaked in 2011, 2012. It came down for 5 years. It started rising again. And we think we are now back into the second leg of that cyclical upward trend, because you've seen an upward shift in the investment demand curve. And starting in 2008, you also saw central banks go from being net sellers to being net buyers.
Well, it certainly feels like a 2015 environment where prices are just flat and will stay flat for a number of years.
I think that we're in a consolidation phase within that second leg up.
Okay, I see. I didn't forget about your price forecast. I promised the audience at the end of the interview. So write in your comment section what you think gold's going to do in the next year or two, and we'll get Jeff's take at the end. Now, the real estate market is something people are really worried about. Rising interest rates are going to cause a collapse of the real estate market. Nothing the collapse I'd like you to address. 30-year mortgage rates are already the highest they've been in the last 12, 15 years in the U.S. So is a crash in the real estate market imminent?
I'm not sure if it's imminent. I'm really concerned about it, and the reason I don't think it's necessarily imminent is because if you look at what's happening in the real estate market right now, it's that financialization. You have this massive amount of investment money coming in and buying houses, squeezing out real would-be homeowners. And that is much more resistant to mortgage rates and interest rates.
Yes.
I think that's one of the factors. The second thing is you have to watch housing starts and housing sales as well as the average price of housing sales. Because what happens and what's happening now is actually housing sales are declining. And I can tell you from my own neighborhood, what's happening is the people with $5 million homes are selling them for $6 million.
Right.
And the people with $1 and $2 and $3 million homes are having trouble buying them. So you see a very sharp increase in the average price of houses being sold, partly because those high-end houses are going up in value because wealthy people are still buying them.
Okay.
But you're seeing fewer houses of lower value being sold.
Yes.
And that has to do with the increased economic inequality and the influx of investment money into the real estate market. So I see these massive problems with the real estate market that, again, the Congress and the administration are doing nothing to deal with. And I think that it's very destructive of economic reality and people's lives. But beyond that, I think that actually will protect us from a collapse of the housing market because the housing market has kind of divorced itself from housing.
We're not going to see 2008 over again. Is basically your take?
I don't think so.
Okay. All right. Well, okay. So let's talk about what to do, because people are asking me, all right, well, you've got your economic outlook. I'm scared. I'm anxious. Whatever you want to call the sentiment. What do I do now? Is what people ask me from an investment point of view. So let's put all this together. You think a recession's on the way. You've listed your reasons why. Nothing is really going to collapse or fall apart, but we are headed for muddy waters. What should we do now?
Okay, we are headed toward a recession.
Yes.
We will see higher interest rates.
Yes.
I think what investors should be doing is reducing their debt wherever possible, getting rid of those portions of their investment portfolio that are particularly vulnerable to the downside.
Okay.
More speculative stocks that don't have corporations behind them that are being profitable, and reinvesting. We haven't even talked about decapitalization of the stock market or the bifurcation of the equity market from corporate, from capital formation for companies. But there are a lot of problems in the stock market. But you build up cash, you get rid of your debt, you get rid of your shaky investments, and you buy gold and silver.
How do I know if my investment is shaky?
You do fundamental analysis.
Obviously, I wouldn't buy a shaky investment if I knew if it was
Oh, no,
shaky.
people do that all the time. And in fact, you said this is not 2008. We've been saying for some time, and by the way, that advice I gave you, that's what we were giving our investors advice in 2005.
Yeah.
Now, in 2006, 7, 8, it was the collateralized mortgage obligations. It was an obscure part of the debt market that caused the financial problems that led to the great global financial collapse and the Great Recession. And and I spent way too much time explaining what a collateralized mortgage obligation was back then. And we've been saying for several years that it will be some obscure corner of the debt market that will cause it. It's not going to be treasuries, because everybody watches the treasuries. It's going to be some obscure portion of the debt market. And people say, well, what? And I say, well, I don't know. But if I had to guess, and I've been saying this for several years, if I had to guess, it would be equity derivatives.
Okay.
Because that's where you've got the kind of imbalance between the base, actual equities, and the value of the derivatives based on that base.
Yeah.
That's the same kind of imbalance that we saw in the mortgage market back in 2006, 2007. And that's why you're seeing all of these that's why you're seeing most of the economic weakness in the stock market right now. It's because you have this wild imbalance between the equity base of actual stocks and the derivatives written on them.
Okay. It's not just the stock market reacting to interest rate hikes.
It's partly that. And the guys who have all those derivatives are saying, oh, they're starting to shake, interest rates are starting to rise. It's time to get rid of this spurious stuff.
Okay.
They're taking my advice.
Let's finish off on gold. We didn't have time to talk about silver, but we talk about silver all the time. We'll save that conversation for another segment, Jeff. I talked about $10,000 gold earlier. I want to come back to that. I know that's not within the realm of possibility within the next 2 to 5 years, according to your theory or your economic analysis, but just suppose it were to happen. Let's reverse engineer a scenario in which we get $10,000 gold in, let's say, 5 years' time. What needs to happen?
Yeah, well, I've made the joke that, God would have to come down to earth and say, Jeff's wrong. Because, I don't see a scenario of $10,000 gold.
You don't see a scenario? Okay.
Yeah,
well,
I just don't see it. I do see a scenario of gold going into that $2,000, $3,000 range. A spike to $3,000, but maybe an annual average price of $2,400. That's possible, and that's actually our main scenario.
So 2,100. So what was it?
A range between, say, 2,100 and 3,000 on an intraday basis.
Okay.
And an annual average around 2,400.
By when?
By 2026.
Okay.
Right. And again, just to put it in perspective, gold hit 850 in 1980. The annual average price was 600.
That's really not a huge growth factor if you're talking about 2026, $2,300.
One of the things that astounds me is the people that you interview who say, I don't understand why gold and silver prices are so low. Because gold prices are actually at record levels on a quarterly and an annual average basis.
That is true, but you're talking about a very slow growth factor from now to 2026.
What I'm saying is that we're already well into that second leg up in a secular bull market in gold.
Okay. I'm not discrediting your analysis. I'm just saying, look.
If you're talking about a hostile economic environment where stocks are weak,
right.
And you're saying, oh, but gold is going to rise $1,200 from $1,800.
Right.
Do the math. That's a 67% increase.
Yeah.
And you're going to tell me, what the hell, Jeff? 67% is nothing? Well, oh yeah, because some guy is telling you, I'm all coked up and I think it's going to 10,000.
23. Let's just take 2,300.
What's the annual
gold.
average? No, take the intraday prices because that's what these guys are talking about.
Your target by 2026.
By 2026, I would not be surprised to see 2,300 on an annual average basis.
Annual average basis. Right now we're about, let's just take 1,800. All right. So we're
That's
talking about a
$500.
$500. That's a growth factor of about 30%, 33% over the next 4 years, 3 to 4 years. That's CAGR of, 10% a year.
Right.
Okay, so
now what do you expect stocks and bonds to do?
well, that's
over
my
that same
question,
period?
because you told me we should stock up on defensive assets, including gold and silver. And I'm saying, well, the 10% CAGR is just really not great. I mean, I'm going to go take my capital, put it somewhere else.
The stock market historically has had a compounded annual growth rate of about 5 or 6%. Okay. So this is beating the long-term stocks. But you have to look at it on a cyclical basis. Okay. 10% in an environment where what are stocks going to be doing? 1%, 2%? You were talking about these guys talking about stock market flatlining for the next 50 years.
Right.
I don't think that's true.
Right.
But I think 10% on gold, look, we've done the math, as you know, with the efficient horizon. We've said, if you take a stock investment portfolio that's 50% S&P, 50% T-bonds, and you start adding 5% increments to gold, the best place you would have been between 1968 and 2021 was 25 to 30% of your wealth, of your assets in gold bullion, right? Which is outrageously large amount. So I'm saying, let's go there and put a third of your wealth in gold and have a 10% return on your gold. And then what do you think your stocks and your bonds are going to do during that period?
Well, at least you'll beat inflation, I guess, if inflation.
That beats inflation.
All right. Well, thank you very much, Jeff. Thank you for coming on the show. Appreciate your thoughts, and thank you for watching Kitco News. I'm David Lin.
Kitco News special coverage of the PDAC convention is brought to you by Gold Mining and Uranium Energy Corp.